Hey, what's up, guys? Welcome back to another trade recap. This one's going to be very informative, so do pay attention and listen closely because I think there's going to be a lot of value in this video. So, last week, filming this here on Saturday, there was some technical difficulties yesterday, so it's coming out today. Anyways, so last week we had the Bank of England monetary policy decision. And as some of you may or may not know, the UK just recently went into lockdown. Pretty strict lockdown until December, maybe longer, but at least until December. That's going to put a huge strain on their businesses, on their economy, and so the Bank of England needed to somehow stimulate the economy, right? There was some speculation they might go into negative rates this meeting. That didn't happen. That was a bit of a long shot. And so that partially was a positive coming out of the meeting. So one thing I need to touch on. First, I guess technicals, right? We got a large pullback here. I traded it on GJ, right? We got a large pullback um, into this support. So we have this area of support, right? If we draw a fib from the top to the bottom, it's right around the 21 level. Um, so there were some technical confluences for going long here, but this trade was mostly 90% fundamentals, right? Because I was just trading the rate, the monetary policy decision. So, in those cases, technicals don't make a huge difference, right? The market's going to do what it wants to do. When you're trading a monetary policy decision, I personally don't really trade data releases. I believe there's not much of an edge there. Sometimes there can be, but there's a lot bigger edge in trading monetary policy decisions, in my opinion, even though it's rare that I will trade them. And so basically, you need to know what's expected beforehand, right? And I don't just mean in terms of the rate, because a lot of people think, oh, it's just the rate decision. If I've seen this on some sites. If the rate stays the same, the currency does this. If it gets cut, the currency does this. If it gets raised, the currency does this. That's somewhat true, but a lot of that pricing in happens beforehand, meaning the market before the actual decision will already account for that change in rates. And so what's really important is you need to know what's expected from all fronts when going into a meeting. That means you need to. So there's the interest rate. Interest rate. There's QE, and there's speech. All right, so there's three different components. There's the interest rate decision. There's QE, quantitative easing. And then they usually have a speech, aka also just a statement that they release, right? So you need to know what's expected for all of these because that will be important, not just the interest rate. And so in this meeting, the interest rate was expected to stay the same. So because it was expected to stay the same, you'd say, how the hell would you know this thing's heading higher, right? One way I knew was the QE part, quantitative easing, asset purchases, stuff like that, right? They were expected to raise it. They're expected to raise their QE by roughly 100 billion. But estimates said 50 to 200 billion. So, the baseline scenario, they would raise it $100 billion. And that would still moderately help the pound. Why is that? Well, we've seen some weird market dynamics, especially when a country's in lockdown. So these are things that really only comes with looking at the markets, with experience, with being in the trenches, right? So back in the Corona days, when back in like March and April, where things were in strict lockdown, market dynamics flipped because things were in such a dire scenario that QE, more QE, which normally would hurt a currency and depreciate it, actually helped. It actually, the markets perceived that as a good thing. Why did it flip? Like I said, because the situation is just so dire that, it almost needs saving. Whereas normally, if it's just like a recession or a small, whatever, and they would increase QE, that would be negative. But if things are so bad, then, the markets actually perceive it as a good thing. So essentially, now that the UK is back in lockdown, those market dynamics came back, and, that's just what happened. So, even the last few months, market dynamics went back to normal, and more QE was generally seen as a bad thing. Except now the UK is back in lockdown, it's flipped again. All right, and we saw that in the market. That's why a lot of people got, were confused of why it went up with more QE. That's why I said context matters, right? So you need to be paying attention to this stuff. Not to mention, so if it was just 100 billion, the consensus, it would be moderately bullish, right? However, it actually was 150 billion. So normally that would be extra bad because more QE is considered, it should depreciate a currency. But since market dynamics flipped here, more QE was good. And so this 150 billion helped it even more, right? And was just more bullish for the pound. So because of this, that's why I took the trade. I saw that they increased QE. Well, even beforehand, I was expecting it to be bullish because of this, and so I actually got in before. That helped me out, right? I saw 150. Okay, better than expected. And, took profits when it headed up. My stop loss was right here. So, that was sort of the trade. Let me mark it off here. Right, so I took profits somewhere around there. This was my stop loss. Or actually, sorry, no. I got in right here. This was my stop loss. This was my TP. So, risk reward, not the best, right? Not quite even a 2-to-1, but the likelihood of it going down here, the likelihood of them introducing negative rates was very low, and that was really the only risk, was that they would cut rates, and that risk was low. So I felt comfortable with this trade, right? We could just see what happened next. Obviously I got out too soon, but at the same time, you can never be too sure. A lot of times these decisions go up, and then who knows, someone makes a comment and it could go right back down. So I'm not complaining. However, there's one more aspect I want to touch on here, and that is the speech part, aka they didn't even mention negative rates at all, basically. So not only did they not introduce negative rates, which was a plus for markets, they didn't even mention it, and so all these factors combined helped the pound surge. Could have caught quite a few more pips, but that's where it now sits. So, anyways, that was the trade. That was the recap for the meeting. So, just a couple things to take home here. Make sure you have expectations. You know all the expectations beforehand, not just the interest rate, right? And then once it comes out, or even beforehand, if you have a strong opinion, you can trade that. But even as soon as it comes out, there's still some pips to capture, right? As soon as it came out, you had some time to react before we saw this huge move, right? Let's see. So came out here and then dipped down here. So you could have got in right here and still captured 60 pips. So you can still get in afterwards, but In general, you'll probably get a better price if you get in before. Anyways, that is all for the recap. I hope you guys learned something. I hope it was helpful. If it was, do give this video a like. And yeah, I'll see you guys in the next one.
I come from a town where most of the people are so close-minded. They go into school and they work in a job, but they don't even like it. I won't be put in a box. Nobody telling me what I should rock. Nobody telling me what I should